This Excel workbook is going to help you understand the relationship between leverage in the capital structure of a firm, earnings, and the value of the firm. In Chapter 13, we learned that the capital structure of the firm can vary in terms of the proportion of leverage that's used on the balance sheet to support the firm's assets. And again, when we use the term leverage, we're talking about the amount of debt that the firm uses to support its assets versus equity. This worksheet is going to help us understand the interplay between leverage in the capital structure, the earnings of the firm. In this case in particular, we're going to look at EBIT, earnings before interest and taxes, and the value of the firm as measured by earnings per share or return on equity. This workbook has several worksheets. There's the data input worksheet. This is where you're going to put all the numbers to explore various scenarios. You will also use this Excel workbook to complete test 4. The data input worksheet is where you should be changing values to answer the various questions on the test. Now, as normal, if a cell is not colored yellow, if a cell is yellow, don't change it. If a cell is colored yellow, don't change it. If a cell is colored yellow, do not change it. Any of these other cells that are colored white, you can change, and you can even change these cells here for EBIT. You can change the values in these cells for EBIT. So if there's a recession, in this case we're saying that EBIT is going to be 4.5 million. If there is a normal economy, we're saying EBIT is going to be 7.5 million. And in this case, we're saying if there's a boom or expansion economy, it's saying EBIT is going to be 10.75 million. Now again, when you're taking the test, you can change these values. You can change any of the values in the white cells. Just do not change any of the values in the yellow cells. I have a little flag on the yellow cells that says do not change formula in the cell. So again, that's the input cell. The only other cell on this worksheet where you will change values is on these break-even scenario worksheets. You can change this value as you try to find the EBIT that makes the debt-free capital structure and the scenario A capital structure equivalent. And on this worksheet, break-even scenario B. Again, you can change the EBIT on this cell. And again, I have a flag here that says this, the only number you should change on this worksheet. So you can change this value on the worksheet on break-even scenario B, but you shouldn't change anything else. That's why all these other values are in yellow. Let me quickly walk through the various worksheets in this Excel workbook. As I said, the first worksheet is the data input worksheet. This is where you would capture or input information about various scenarios that you're trying to explore. So you put the total assets of the firm, total debt of the firm, the debt to equity ratio will be calculated, share price of the firm, number of shares outstanding, the marginal tax rate, and the interest on any borrowings. And so again, here's a debt-free scenario. That's the current scenario. There's secondaries. There's a scenario A that's reviewed in the PowerPoint presentation for Chapter 13. And this is a 1-to-1 debt to equity ratio. And then there's a scenario B where we have a 3-to-1 debt to equity ratio. Those we have debt of 75 million, equity of 25 million, so that's 3-to-1. So again, you can change the values in the white cells here. The second worksheet reports the return on equity and earnings per share for these three scenarios. The scenario with no debt, scenario A with a debt to equity ratio of 1:1, and scenario B with a debt to equity ratio of 3:1. So again, this reports results. So you would go to this worksheet if you were working on a problem where you're looking at a scenario where we're not considering any taxes, we're not taxing the firm, and you want to understand how leverage impacts return on equity and earnings per share. This third worksheet is a worksheet where we try to determine the level of EBIT, earnings before interest and taxes, that makes the earnings per share the same for the capital structure with no debt versus a capital structure with a debt to equity ratio of 1:1. So again, we try to determine what EBIT level will make these two return on equities or equivalent. This worksheet break-even scenario B looks at the capital structure when we have no debt versus a capital structure where we have a 3:1 debt to equity ratio. And again, we're trying to determine what level of EBIT makes earnings per share the same for both of these scenarios, the scenario with no debt and the scenario with a debt to equity ratio of 3:1. Now this worksheet we would look at if we're dealing with a question where we're looking for the impact of leverage on return on equity and earnings per share, and we are taxing the firm's earnings. So this is going to give us an after-tax impact on return on equity and earnings per share. And again, we wouldn't change anything on this sheet. We would just look at it to find the answers to whatever questions might be relevant. The final worksheet is this interest expense tax shield. Interest expense tax shield. This interest expense tax shield worksheet we would use to determine the present value of the interest expense tax shield. In other words, this represents an increase in value of the firm as a result of a subsidy from the government. This is a subsidy to the value of the firm provided by the government because the government allows the firm to deduct interest paid on debt as an expense when determining its taxable income. The higher the interest expense paid on the debt, the lower the firm's taxable income. Therefore, the lower the firm's tax liability to the government. This represents a subsidy or increase in value of the firm. Now, obviously, here we have two scenarios, a levered scenario where the firm has an EBIT of $1,000, and here we have a levered scenario where the firm has an EBIT of $1,000. Unlevered just means there's no debt. Levered means there's debt. In the unlevered situation, there's no debt. In the levered situation, we have $1,000 of debt. Interest rate on that $1,000 is 8%. We have an EBIT of $1,000 as well. We have a marginal tax rate of 21%. So what we do here is we have the EBIT, we deduct the interest expense, that leaves us earnings before taxes of $920. At 21% or 0.21, the tax liability on that $920 is $193.20. We subtract that $193.20 and that leaves us net income or after-tax income of $726.80. So the firm's cash flow from assets is greater for the levered firm than the unlevered firm. Because for the unlevered firm, EBIT minus the taxes would be 1,000 minus 210, or cash flow from assets of $790. So the cash flow from the firm each year is greater for the levered firm by $16.80. Well, if we get the present value of that $16.80 over time, if we think of it as a perpetuity, then the present value of that is $210. So the subsidy provided by the government, because firms are allowed to deduct interest expense on debt, increases the value of the firm by $210. So that is what this interest expense tax shield is, and that's the present value of the interest expense tax shield.